All right, let's get started right now. And for the previous lessons, I shared you one candlestick pattern, right? Two candlestick pattern and three candlestick pattern. And this time, I will show you how we will react. Yeah, our action when the patterns is false. Because when I share with you that not everything that will be correct, right? It's not always correct in the beginning. And trading is probability. Okay, always remember this. Trading is probability. And today's lesson, I will show you how to handle. Yeah, how to handle when the patterns are false to establish. Okay. And the first one, we were learning about the core principle. The core principle first. Oh, okay. The core principles of this pattern. And if we already recognize the patterns that it was found on the trading chart, but I always remind you, we need to wait for the confirmation from the market. The confirmation candle will appear right after the patterns was found. Okay, so generally the patterns is just a signal. Okay, it's just a signal. It's not a confirm from the market that we enter the trade immediately the pattern was formed. No, we don't do that. Always we will wait for the next candle after after the candlestick pattern was formed. And that is the most important thing. Okay. And it's always if it follow the correct direction of the signals appear, we can enter the trade with the correct direction. Okay. But if this confirmation candle was incorrect with the current direction, for example, if the morning star is the signal for the bearish reversal or for the bullish reversal, but after that, the next candle was formed was a bearish candle. How we do it? Okay, so that time we should consider for the opposite direction. That the candles warning us. Okay, give us the alert. Yeah, the alert. And in trading, the failure of the common patterns is a proof that the opposing side lacks the strength to maintain its position. Okay, so this is the core principle we need to remember for today's lesson. Okay, so how about the reverse psychology? And when the reversal patterns like a morning star, yeah, I just give you an example, was formed, it attracts a large number of traders who try to buy. And if this pattern fails, like the price drops below the pattern's low, all those buy orders have to be closed. Okay, closing those buy traders generates a massive volume of sell orders, providing the momentum to push the price further in their own direction. And regarding to logical entry point, the failure point of this pattern becomes a higher confidence entry point because it is confirmed by both psychology, which is buying greed has been punished, and technical actions like breaking the key support level. Okay, so this is a key trading. You need the definition. You need to remember when we start to trade with the phone signal alert. And the next one, I will show you how we can applying three candle patterns, false, false morning star and evening star. There will be two pairs of patterns relating to three candlestick pattern today I will share with you because they are more reliable. Okay, they are more reliable than the previous one candlestick pattern and two candlestick pattern. For two candlestick patterns, of course, I usually told you that the most common patterns that usually appears on the real trading chart is the bullish and bearish engulfing pattern, right? And after that, I will show you how we should do when there are falls. Okay, and firstly, we will start with applying the three candlestick patterns falls. Okay, I would like to add the falls three candlestick patterns, and in today's lesson, I will show you two common patterns that usually appears on your real trading chart, morning star and evening star. Okay, so do you still remember the shape of these patterns? Okay, so let me help you to show the appearance of these two patterns. Okay, they are three candlesticks making a group. One is indicates for the bullish reversal, like morning star, and on the other hand, evening star represent for the upcoming bearish reversal. Okay, so this is how they look like. And what if it falls? Okay, first we will explore the theory first, and then I will show you the example on your real trading chart. Okay. For the morning star, like this. Okay, I will show you this photo for you imagine first. This is the first example for the morning star. You see that it appears after a downtrend, a short downtrend, right? But it's not a signal for the reversal, for the bullish reversal at all. Because you can see that there are powerful bearish candles happened. Okay, after that. And this is the phone's Morningstar candle, Morningstar pattern was formed. So you can say that the next candle is a bullish one, right? But the fourth candle is a very powerful bearish candlestick, right? It's totally destroyed the previous bullish momentum. Yeah, this bearish one. So that's why we always need to wait for the signal that the upcoming bearish candlestick is forming. Yeah, it will forming a trap for you, a bullish trap for you. There will be some reason. There will be some reason for this case that it falls. First, that you see that the previous downtrend is not clearly. Yeah, and the momentum of the bearish of the downtrend is very short. It's forming higher lows, right? Even though it's forming a lower highs, but you see this bottom is higher. Okay, so it's not a specific downtrend. Second, if we turn on the volume, indicators, you will see the volume is not significant to getting the reversal. And lastly, the bullish candlestick is not big. Yeah, the next candlestick candle is not big enough to show the determinations of the bullish dominating the market. And after that, there is the bearish jumping, yeah, and destroy all the previous bullish momentum. So how do we realize and set up the entry zone for this time? Because if we understand this is the phone signal, we can easily to enter the trade and capitalize on the market movement. Now, like this case, okay? And the failure conditions, like I just shared with you, is the price breaks below the lows of the pattern. Price break below the low of the pattern. Okay, and this is usually the low of the second or the first candle. Focus on this powerful bearish candlestick. Okay, and the momentum of this signal is you can enter a sell trade after the price definitely closed below the pattern's low. And for the stop loss, you can place it just above the high of the pattern, which is above the high of the second candle, yeah, to prevent the liquidity sweep or stop loss sweep. Okay, so this is the example for you, and we need to observe and identify the locations of the patterns appears. Okay, and for the Morningstar, it usually appears at the key resistance, key support level, and after a downtrend. Okay, a specific downtrend. For this case, the downtrend is very short. You can see that the previous candlestick was very short, and this is the 5-minute time frame at all. So it's not long enough to make this case more reliable. And it's easily forming a false Morningstar pattern. Okay, Morningstar patterns is the signal for the bullish reversal. Okay, and even though that the next candle appeared like a bullish one, but you can see that the body is not big enough to beat all the sellers, right? So it's easily forming a very powerful bearish candle after that. So this is our chance. And you can see that price dropped significantly from the level 41.14. It looked like a 41 13 41.13 down to 14.19 14.19. More than 100 pips profit in your hand. If you can realize that in some case, even though the pattern was formed, but the conditions is irregular. Okay, it's irregular. It's not a very strong downtrend before that, and the volume is not significant, and the body of the bullish candlestick is not big enough to beat the sellers. Okay, so we can gain the chance, okay, to enter this signal to capitalize our trading result. Okay, so this is the first example, and I show you how to set up the entry. Okay, I will illustrate on the chart. So it will help you a lot to imagine and understand the theory easily. And I would like to explain again for the entry zone that you see that the middle, yeah, the price, the entry zone will be set up, yeah, about the middle, yeah, the middle of this powerful bearish candle, or or uh two price, 1 to 2 price near the range of the half of the bearish candle. Okay. So this is going to be considered like the perfect entry zone for us. Yeah, for the opposite position, like selling signal. Yeah, sell signal. Okay, so I will show you the theory. Okay, the theory of the first. Okay, let's me scroll it. Theory of the how we react, how we do the action. Yeah, how we act with this case. This is the morning star, and this is the failure conditions. Okay, and for evening star, this is the bearish reversal, and it usually appears at the key resistance level, right? At the resistance level, and of course, it will be after a strong uptrend. Yeah, opposite to the morning star. And the failure conditions is the price breaks above the high of the pattern, and usually highs of the second or first candles. Okay, for the buy, enter a buy trade after the price definitively closes above the high of the pattern. It will opposite, to the morning star. So you can remember one pattern, and then we make the analysis for the opposite one. Okay, so that's the tips to help you remember two knowledge at the same time because they are opposite. Okay, it's easy, right? And if you want to remember the patterns and the failure conditions, just open your trading chart, looking for where is the positions of the resistance and support zone. Okay, so it will help you a lot to remember those knowledge. And now let's go to the next part. We were talking about the bearish candlestick pattern. When is it failure? So today's lessons is kind of simple because we're talking about when the market's forming for the traps and how we face with the trap and handle it. And a fail engulfing patterns creates a powerful trap we call bull or bear trap. So this name is very familiar for everyone, right? So let me show you the example. I will describe based on this example. Okay. Now we're talking about the bullish engulfing failure, or we usually call it the bull trap. Okay. The bullish engulfing candle, which is the second candle, totally engulf the previous one. It attracts the buyers, like this one. If the subsequent candle immediately breaks and closes below the low of that engulfing candle, it's the bull trap. And also there another scenario that it continues to forming a consecutive bearish candle. Yeah, like you can say that after that, the market forming the three black rounds. The three black rounds pattern after that, three bearish consecutive candles. Right after this bullish engulfing candle patterns was formed. Okay, so even though that they are lying at the key support, yeah, you can say that we are having three EMAs here, right? EMA ribbons, EMA 200 ribbons here. Below is EMA 89. And you know the usage of EMA setting already. They are acting like the support zone. Yeah, the dynamic support level. But after that, there were three consecutive bearish candle was formed. And if we follow the buy order, we definitely hit the stop loss, right? Because we usually set the stop loss below the candle wicks. And you can see that clearly it hit that level. So that's why when I see this bearish candle was formed, we will wait. We will wait for the next movement of the market. You see that if this is the bearish bullish engulfing pattern, it must be forming a bullish candle after that, right? But it's not. It's not. The market was forming a bearish candle. It's not a bullish one. So we should down to the market. Okay? And this is where we can enter the opposite direction, opposite position. Okay? And you can see that after that, the candle forming with a bearish candle. And the middle price of the next candle will be our entry zone because this is the time the buyers wasn't supported any longer. And now it's time for the sellers dominating the market. Okay, so why don't we follow them? Why don't we follow the sellers to capitalize our trading result, right? So our entry zone will be set as the middle of the candle and until the closing price of the next candle. Okay, focus on the click. Yeah, because I forgot to make the ruler. Yeah, for our entry and stop loss. So focus to the lick. I will illustrate from this candle pattern for you. Okay, and now we realize that, okay, so the market was supported by a lot of sellers, and now we set up the sell scalping signal, and the price zone, the entry zone, is about half of the candlestick until the closing price. Okay, or you can follow the range 1 to 2 price. Yeah, like I usually post the signal on the VIP signal group. Okay, and the stop loss we will set at the previous high. Okay, as the previous high, a bit distance. Yeah, a bit distant, far away from the previous engulfing candlestick wicks. Yeah, to avoid a liquidity and stop loss sweep. Okay, and take profit. We can set as the previous low. Okay, so you can see that when we enter the correct direction, it will bring you around, let me check, from 91 and it dropping down to 70. Wow, 200 pips. Okay, so if we can realize this better and we're flexible to change, yeah, to change with the real scenario that the market is happening at that time. Okay, so it's not always follow the correction. Okay, the patterns, all the patterns still have the probability to fail, and not this time. Okay, and throughout this lesson, I will share with you what is the failure scenario, the failure conditions, so we can realize it and control it. Okay. So on the other hand, for the bear trap, like for the bearish engulfing failure, okay, if the bearish candle is invalidated, when the price breaks above its highs, yeah, and traders should enter buy trade. It will opposite to this bullish engulfing failure. So today's lessons is very simple, and now let's move to the real-time chart. Looking for another example for today's lesson. Okay. So that is the theory, yeah, of today's lesson. So anyone have the question, you can feel free to post it on the chat box.